Listen carefully, because the mistake most people make in moments like this is that they look at the headline and miss the machine underneath it. They hear about a new Federal Reserve chair or a new policy direction or a viral claim that America has found a way to make its debt problem disappear. And they treat it like politics. They argue about the person, they argue about the party, they argue about whether the media is exaggerating. That is not how I look at it. I look at it as a system. I look at the debt. I look at the incentives. I look at the constraints. I look at what has happened in history when countries had similar debt burdens and similar political limits. Then I ask a simple question: what is the most probable path from here, right now? There is roughly $39 trillion of federal debt sitting on top of the American economy. That number is so large that the human mind has trouble processing it. When numbers become that large, people stop thinking, they hear trillion, and it becomes just another word. That is dangerous, because a number that big is not just a number. It is a claim on future income. It is a claim on future taxes. It is a claim on future purchasing power. It is a claim on the savings of people who do not understand that their savings are already inside the machine. The important thing is not only the debt. Debt by itself can be manageable. If income grows faster than the debt, if interest rates stay low enough, and if the political system is willing to make hard choices, the problem is that those three things are no longer lining up. The debt is growing very fast. The economy is not growing fast enough to make the debt ratio comfortable. And the interest expense has become one of the largest parts of the federal budget. That is the part most people miss. The government is not just paying for roads, defense, Social Security, Medicare, or education. It is paying rent on money already spent. Roughly $1 trillion a year in interest is not a productive investment. It does not build a factory. It does not educate a child. It does not create a new technology. It is simply the cost of yesterday's decisions showing up today. When a society reaches that point, the choice is narrow. Many people still think this problem will be solved through normal politics: raise taxes, cut spending, grow faster, be more responsible. That is what people say because it sounds reasonable. But in debt cycles, what sounds reasonable is often not what actually happens. Let us think through it like a system. If the government tries to tax its way out, it quickly runs into a political and mathematical wall. You can raise taxes at the margin, you can tax high earners more, you can tax capital more, you can tax corporations more, but the debt and interest burden are too large to be solved by one narrow tax base. Even if you took far more from the wealthy, it would not fix the long-term compounding problem. It might buy time. It would not change the structure. If the government tries to cut spending, it runs into an even larger wall. The biggest spending categories are politically protected. Social Security, Medicare, defense, and interest are not easy to cut. Interest cannot be cut without default. Social Security and Medicare affect tens of millions of voters. Defense is tied to geopolitical power, so the theoretical solution exists on paper, but in the real political world, it is almost impossible to apply at the scale required. If the government tries to grow out of it, it needs growth strong enough to outrun debt accumulation. That can happen for a while in a productive economy. But when debt grows faster than income for long enough, the compounding works against you. The system needs either extraordinary productivity growth, sustained low interest rates, or inflation that reduces the real value of what is owed. That is where the real story begins. The most likely solution is not announced as a solution. It is not sold honestly to the public. It happens quietly through a policy mix that has been used before. It is called financial repression. Financial repression sounds technical. It is not complicated. It means the government and the central bank create conditions where interest rates are kept below the rate of inflation for a sustained period of time. When that happens, the real value of debt declines. The debtor wins, the creditor loses. The government, as the largest debtor, benefits. Savers, bondholders, and people holding too much cash lose purchasing power slowly. The nominal number stays the same. The real value shrinks. That is the key. The debt is not canceled, it is diluted. If you owe someone $100 and inflation makes $100 worth much less over time, you have reduced the real burden of that debt without ever defaulting. The person you owed money to still receives the dollars they were promised. But those dollars buy less politically. That is much easier than an explicit default economically. It transfers wealth. This is why I do not focus on the phrase cancel the debt the way social media does. Debt does not need to be canceled in the dramatic sense. It can be made smaller in real terms. It can be inflated away. It can be repressed away. It can be moved from the balance sheet of the government to the purchasing power of households. That is what serious investors need to understand. The danger is not that you wake up one morning and your bank account says zero. The danger is that you wake up 10 years from now and your bank account still has the same number, but it buys far less of what you need. That is the silent tax. That is the tax people do not vote on. That is the tax that does not require a bill from Congress. It shows up in food. It shows up in housing. It shows up in insurance. It shows up in medical care. It shows up in the cost of building, shipping, borrowing, and living. Most people do not see it as policy, they see it as life getting expensive. But life getting expensive can be the mechanism. This is why the coming Federal Reserve leadership matters. Not because one person is a king. The Federal Reserve Chair does not control everything. There are voting members, there are market constraints, there are political constraints, there are global capital flows. A central banker cannot simply declare a new reality and make it so. But leadership matters because it shapes the bias of the institution. If the bias shifts toward tolerating more inflation, managing rates more aggressively, shrinking or reshaping the balance sheet, or keeping real rates lower than savers expect, then the entire asset pricing system changes. It does not change all at once. It changes through expectations, then through valuations, then through capital allocation, then through the daily decisions of investors, banks, pension funds, corporations, and households. Most people wait for the official announcement. Professionals watch the direction of travel. The direction of travel is what matters. When you have a debt burden this large and interest costs this high, the system naturally wants lower real rates. It wants inflation to be higher than the interest paid on the debt. It wants the nominal economy to grow faster than the debt burden in real terms. It wants savers to accept returns that feel safe but are quietly negative after inflation. That is the essence of repression, and it is not new. After World War II, the United States had a very large debt burden relative to the size of the economy. The country did not solve that problem by paying down the debt in the way a household pays down a mortgage. It solved much of it by growing nominal GDP, holding rates down, and allowing inflation to reduce the real burden. The debt-to-GDP ratio fell dramatically over the following decades. That period is one of the most important examples in modern financial history because it shows that a government with monetary sovereignty and political constraints will often choose the path that is least visible to voters. Explicit austerity is visible, default is visible. High taxes are visible, inflation and negative real rates are less visible. That is why savers get hurt. They think they are being prudent because their money is not falling in nominal terms. Their account balance is steady, their CD pays interest, their savings account pays interest, their bonds pay interest. But if inflation runs above that return, they are losing wealth in real terms. This is one of the hardest truths for people to accept. Safety is not the same as stability of numbers. If your account says $100,000 today and still says $100,000 years from now, but the cost of a house, medical care, food, insurance, taxes, and energy has gone up substantially, you did not stay safe. You lost purchasing power. You were just allowed to lose it quietly. That is why I measure wealth in purchasing power, not dollars. A dollar is a unit of account. It is not the same as wealth. Wealth is what you can buy. Wealth is your claim on goods, services, assets, labor, and freedom. When the currency is being diluted, counting dollars becomes misleading. If you are standing on a moving walkway going backward and you are walking forward slowly, you may feel like you are moving, but relative to where you need to be, you may still be losing ground. That is how cash and low-yielding assets behave in a repression environment. They feel safe because they do not move much. They are dangerous because the world around them moves. Now, let us talk about the Federal Reserve structure because people often misunderstand it in two opposite ways. Some people think the Fed is a normal government department. It is not that simple. Some people think it is a cartoon conspiracy. It is not that either. The truth is more important because it is structural. The Federal Reserve System contains regional Federal Reserve banks, member banks, boards, public authority, private banking participation, and legal complexity. The structure creates a bridge between government policy and the banking system. That bridge matters because the banking system is one of the main transmission channels for monetary policy. When interest rates change, banks change lending behavior. When reserves change, banks change balance sheet behavior. When the central bank expands or contracts liquidity, asset markets respond. When asset markets respond, households and institutions behave differently. So when I look at the Fed, I do not ask whether it is good or evil. That is not useful. I ask what the machine is designed to do under stress. Under stress, the machine protects the functioning of the financial system first. That is its priority. Because if the financial system breaks, everything else breaks quickly. The consequence is that asset owners are often protected more than cash holders. Not because anyone has to announce that as the moral goal, but because stabilizing the system often means stabilizing asset prices, liquidity, and the balance sheets of institutions. That is why owning the right assets matters. If you own nothing but cash, you are outside the protection mechanism. You are holding the thing being diluted. If you own productive assets, scarce assets, and assets with pricing power, you are more likely to be on the side that adjusts upward as the currency weakens. This does not mean you should be reckless. It means you should understand the cycle. In every big debt cycle, the same basic pressures appear. Debt rises faster than income. Interest costs become burdensome. Political systems avoid direct pain. Central banks are pressured to keep conditions easier than they otherwise would. Currency value declines in real terms. Asset prices, especially productive and scarce assets, rise in nominal terms. People who hold only cash and fixed claims feel betrayed because they did not lose money in the way they were taught to fear. They lost it through purchasing power. That is the playbook. The mistake is thinking it will happen overnight. It usually does not. It is not a light switch, it is a drift. And the drift is what destroys people, because it is slow enough to ignore and powerful enough to change everything. A market crash is emotionally dramatic. Inflation is psychologically subtle. In a crash, you know you are being hit. In inflation, you often do not realize the hit until years later. That makes inflation a more effective tool for transferring wealth, because the transfer happens gradually. That is why I am less interested in predicting one exact rate cut, one exact policy date, or one exact person's plan. Those are headlines. The deeper reality is that the debt dynamics are forcing the system toward lower real returns on safe assets. If that is true, then the question becomes practical. What do you own? Not what do you believe politically? Not what do you hope happens? Not what headline made you angry this morning. What do you own? Do you own claims that will be paid back in depreciating dollars? Do you own long-duration bonds that could suffer if inflation stays higher than expected? Do you own too much idle cash because uncertainty made you freeze? Or do you own a diversified mix of assets that can adjust, reprice, and survive the environment? This is where most people fail. They confuse thinking with positioning. They understand the problem intellectually, but they keep their financial life structured for the old world. They hold too much cash. They hold bonds that look safe but have real rate risk. They avoid equities because volatility scares them. They avoid real assets because they feel complicated. They avoid gold and other scarce assets because they do not produce income. They avoid diversification because one story has captured their imagination. Then the cycle moves, and they discover that understanding without action is not protection. The first principle is to stop measuring your financial security by account balance alone. Measure it by what the balance can buy. If your portfolio went up but the cost of everything you need went up faster, you did not win. If your savings account paid you interest but inflation was higher, you did not win. If your bonds paid coupons but the real value of those payments declined, you did not win. This is not pessimism, it is accurate accounting. The second principle is that productive assets matter in inflationary and repressive environments. High-quality equities can be one of the most important defenses because good businesses can adapt. They can raise prices, they can improve productivity, they can grow earnings in nominal terms, they can own assets, brands, distribution, data, technology, and customer relationships that reprice with the economy. But quality matters. Not every stock protects you. Weak companies with no pricing power can be hurt badly by inflation. Companies that depend on cheap financing can suffer when capital costs rise. Speculative companies with distant cash flows can be repriced violently. The companies that matter most are those with durable margins, strong balance sheets, real cash flow, and the ability to pass through costs without destroying demand. That is why I look at pricing power as a survival trait. In a world where money loses value, the businesses that can reprice their goods and services are structurally different from those that cannot. They are not just businesses, they are inflation, adjusting machines. The third principle is that hard assets matter because they cannot be printed. Real estate, when bought at a sensible price and financed prudently, can serve as a claim on shelter, land, rent, and scarcity. Gold and silver can serve as monetary hedges because they are not liabilities of a government. Certain scarce assets, if genuine and liquid enough, can preserve purchasing power because they are difficult to create more of. But again, there are no perfect assets. Real estate has taxes, maintenance, leverage risk, and local market risk. Gold has volatility and no cash flow. Silver can be even more volatile. Collectibles can be illiquid and hard to value. The answer is not to worship any one asset. The answer is to understand what each asset does in the system. The fourth principle is that diversification across asset types is more important than emotional certainty. People like certainty, they want one answer. All stocks, all gold, all cash, all crypto, all real estate, all one country, all one thesis that feels emotionally clean, but it is often financially fragile. The world is not one variable math. It is a system of interacting forces: inflation, growth, productivity, war, debt, demographics, energy, technology, politics, and psychology. All move together. When you concentrate everything in one asset class, you are saying you understand the future better than the future itself. That is usually arrogance disguised as conviction. A more resilient approach is to own a mix of assets that can perform under different outcomes: productive businesses for growth and pricing power, hard assets for currency debasement, some liquidity for optionality, shorter duration instruments, rather than locking too much wealth into long claims that inflation can erode. Real assets when priced sensibly, and enough diversification that one wrong thesis does not destroy you. This is not exciting. It is how serious capital survives. Now let us talk about the traps, because the traps are where the most damage happens. The first trap is long duration bonds in a repression environment. Long duration bonds can look safe because they pay fixed income and are tied to high-quality borrowers. But if inflation runs above expectations and rates move against you, the real value of those fixed payments can be crushed. You receive the dollars, but the dollars buy less. If you need to sell before maturity, price losses can also hurt you. The problem is not that bonds are bad. The problem is that duration is a real risk. In the wrong environment, duration turns safety into a slow loss. The second trap is holding excessive cash because uncertainty feels uncomfortable. I understand the emotional logic. When the world feels uncertain, people want cash. Cash gives optionality. Cash gives psychological comfort. Cash protects you from short-term market volatility. A reasonable liquidity reserve is important. But too much cash in a financial repression cycle is not caution. It is exposure to currency debasement. People think cash has no risk because the number does not fluctuate. But the risk is hidden in what the number can buy. If you hold cash for years while the system is deliberately reducing the real value of debt through inflation and low real rates, you are helping finance the adjustment. That is what people need to understand. The third trap is believing that international diversification alone solves the problem. There are good reasons to own assets outside one country: currency diversification, market diversification, geopolitical diversification, and valuation diversification can all matter. But it is naive to think that simply moving money abroad escapes the debt and debasement cycle. Many developed economies face similar problems. Europe has debt and demographic pressures. Japan has lived with extreme debt dynamics for decades. China has its own debt, property, and capital control issues. Emerging markets can grow faster but carry governance, currency, and volatility risks. The asset class matters, the quality matters, the price matters, the liquidity matters. Geography alone is not a magic shield. The fourth trap is chasing viral certainty. When people are scared, they want someone to tell them exactly what will happen: a specific date, a specific rate, a specific person, a secret plan, a guaranteed outcome. That is how bad decisions get sold. Reality is probabilistic. The most likely path may be clear, but the exact route will be uneven. There will be policy reversals. There will be market rallies that make the problem look solved. There will be sell-offs that make people panic. There will be political fights. There will be temporary disinflation. There will be temporary spikes. There will be experts on television explaining yesterday's move as if it was obvious. If you build your financial life around one dramatic prediction, you become fragile. If you build it around a deep understanding of the debt cycle, you become harder to shake. That is the difference. The way I would approach this is not with panic. Panic is almost always expensive. I would approach it with principles. I would first make sure I understand my real liquidity needs, not imaginary comfort cash. Real liquidity, emergency expenses, taxes, near-term obligations, and money I cannot afford to expose to volatility. That money needs safety and access. But beyond that, I would be careful about letting fear turn into permanent cash hoarding. Then I would examine whether my portfolio is too dependent on one outcome. Too much long-duration fixed income, too much cash, too much speculative technology, too much real estate with leverage, too much exposure to one country, one currency, one sector, or one story. Concentration can create wealth, but unmanaged concentration can also destroy it. Then I would look for assets that have a reasonable chance of maintaining or increasing real purchasing power over time. High-quality businesses with pricing power, real assets bought carefully, scarce monetary hedges in an appropriate allocation, shorter duration instruments for the defensive side, and a system for rebalancing, because what is sensible today can become too large tomorrow if one asset runs far ahead of the rest. The purpose is not to predict every move. The purpose is to avoid being forced into bad moves. That is one of the most important principles in investing and in life. If you are overextended, you will be forced to sell at the wrong time. If you hold no liquidity, volatility will control you. If you hold only cash, inflation will control you. If you hold only one story, the failure of that story will control you. The goal is to construct a financial life where you have options. Options are power. The people who do well in these environments are rarely the people who shout the loudest. They are the people who quietly understand the mechanics and position before the crowd is forced to react. They know that when a government has too much debt, the currency often becomes the adjustment mechanism. They know that when real rates are negative, savers subsidize debtors. They know that when inflation is tolerated, assets that can reprice tend to outperform fixed claims. They know that when the public finally notices, much of the adjustment may already be reflected in prices. So they move deliberately. They do not wait for the central bank to announce, "We are going to reduce your purchasing power." No serious institution announces it that way. They say they are supporting employment. They say they are preserving financial stability. They say inflation is transitory or contained or moving in the right direction or necessary to balance risks. They use language designed to maintain confidence. Confidence is part of the system. But capital should not be managed on comforting language. It should be managed on incentives and constraints. The incentive of a heavily indebted government is to reduce the real burden of debt. The constraint is that explicit default is unacceptable, and deep austerity is politically dangerous. The practical path is repression. That does not mean a straight line. It means the bias of the system points in that direction. Once you see that, you start asking better questions. You ask whether your assets are claims on depreciating money or claims on productive capacity. You ask whether your income can adjust with inflation. You ask whether your savings are protected in real terms or only nominal terms. You ask whether your portfolio is resilient across scenarios or simply comfortable in the scenario that just ended. That last point is crucial. Most portfolios are built for the environment people just experienced. After a long period of falling rates and rising asset prices, people assume that the same mix will work forever. After a period of low inflation, people assume cash is not dangerous. After a period of easy money, people assume speculative assets always recover quickly. After a period of outperformance, people assume one country's market can dominate indefinitely. But cycles change. The machine does not care what worked for you emotionally. It responds to debt, liquidity, productivity, policy, and incentives. That is why the new Federal Reserve leadership is not the whole story. It is a catalyst inside a much larger cycle. The chair may influence the pace, the voting members may shape the path, politics may change the communication, markets may force adjustments, but the debt math does not disappear because one person speaks well or badly. The debt is still there. The interest expense is still there. The political difficulty of cutting spending is still there. The temptation to let inflation do the work is still there. The saver's vulnerability is still there. And the opportunity for asset owners is still there. That is the uncomfortable part. The same policy environment that punishes savers can reward owners of the right assets. That is why this is not only a warning, it is also a map. If you understand it early enough, you can stop being the person the system extracts from and become the person who understands where the extraction is going. That does not mean you become reckless. It means you stop mistaking inactivity for prudence. Inaction is still a decision. Leaving large amounts of money in cash is a decision. Holding long-duration bonds through an inflationary regime is a decision. Owning no scarce or productive assets is a decision. Refusing to study the debt cycle is a decision. The fact that those decisions feel passive does not make them neutral. The system will still act on you. This is why I would urge people to think in terms of purchasing power immediately. Take your savings, take your income, take your portfolio, then ask what it buys today and what it is likely to buy in 5 or 10 years under different inflation paths. That exercise is more useful than watching another political argument, because when you do it honestly, you realize that the danger is not abstract. It is your retirement, it is your cost of living, it is your ability to help your family, it is your independence, it is your freedom from being forced to work longer than you planned because the money you saved did not hold its value. That is why the stakes are high, and that is why the tone around this subject should be direct. You cannot control the national debt. You cannot control who sits in the Federal Reserve chair. You cannot control whether politicians make responsible decisions. You cannot control whether the media explains this well. You cannot control whether inflation is reported in a way that matches your lived experience. But you can control whether you understand the machine. You can control whether you measure your wealth properly. You can control whether you diversify across assets that are more likely to survive repression. You can control whether you reduce exposure to traps that look safe but are dangerous in real terms. You can control whether you act before the crowd is forced to. That is the point. Do not wait for certainty. Certainty usually arrives after the price has moved. Do not wait for permission. No one in power benefits from telling savers plainly that their purchasing power is the release valve. Do not wait for panic. Panic causes people to sell what they should hold and buy what they should question. Move calmly, move rationally, move with a system. The debt cycle is not mysterious once you understand it. It is a sequence of cause and effect. Too much debt creates pressure. Political constraints limit direct solutions. Monetary policy becomes the adjustment tool. Inflation and negative real rates reduce the debt burden. Savers lose, asset owners adjust, the unaware complain, the prepared adapt. That is how it has worked before. That is how it is likely to work again. The question is not whether the exact path will match any viral video. It will not. Reality is always messier than the presentation. The question is whether the broad forces are clear enough to justify preparation. In my view, they are. And once you accept that, the next step is not fear. It is design. Design a portfolio. Design a liquidity plan. Design a debt strategy. Design a way to own productive and scarce assets without over-concentrating design rules. So you do not make emotional decisions when headlines become more extreme. Because the machine will not stop. It will not slow down because savers are uncomfortable. It will not pause because retirees need more time. It will not explain itself in plain English. It will continue operating through interest rates, inflation, liquidity, asset prices, taxes, deficits, and confidence. You can be confused by it, or you can study it, you can complain about it, or you can position for it. You can be under it, or you can understand how to stand beside it. That is the real choice. The people who win the next decade will not necessarily be the people with the highest income today. They will be the people who understand purchasing power, debt cycles, and asset ownership before those subjects become impossible to ignore. Because by the time everyone understands the problem, the easy part of the opportunity is usually gone. And that is why this moment matters.